Okay, let's do a quick recap of the different kinds of predictive trades. We're going to discuss intraday, swing, and positional once again, right? So we kind of have clearly understood what is intraday. Intraday means that kind of a trade where you start your trade in the morning when the market starts, and you close all your positions at the end of the trading period in the same day. You do not carry forward your position. That is intraday. In between that particular day, that is called as intraday, right? So you will look for trading opportunities that may appear in the morning or in the evening or when the market is closing, whatever time kind of suits you, and then hold that for a certain period of time within that day. So you can trade in shortest time frame from 1 minute, go all the way to 1 hour, even 2 hours, as well as the case may be. But what we would recommend at this stage is try to do it at 15 minutes time frame, which is very, very standard, where the momentum is there, where the push is there, where the volume is there, and it is kind of good to kind of stick to that time frame, which majority of the people do in the markets to begin with. Of course, after that you can explore various time frame. So intraday is you start in the morning, and then you end within the same day, and then catch on to the price fluctuations which happens within a day, right? And no carry forward of any position to the next day. So that is predominantly intraday. Now in intraday, one more concept I want to share, which is the trading zones. In a day, especially for NSE, see, we will trade predominantly in NSE, because of the volumes what it has and the depth with which we can kind of trade. Especially if you are trading in derivatives, NSE is the best. So now market opens at 9:15, closes at 9:30 every day. It opens at 9:15. Of course, the tick starts at 9 o'clock. That is the pre-market. For 15 minutes, you can see the pre-market details, and then at 9:15 the trading starts, and 3:30 the trading ends. So now there are 3 zones typically in the market. Now, what are these zones? Let me kind of describe that to you. So the 3 zones. Zone 1 is called as the morning zone, which starts from 9:15 a.m. to 11 a.m. 9:15 a.m. to 11 a.m. So now this is a zone where you will see a lot of momentum, and also you will see some amount of volatility in this zone, where market can go up and down erratically between 9:15 to 11 a.m. and sometimes it can simply have huge momentum only without volatility, right? So that is the first zone. When the market opens, whatever people have thought about the previous day, all of that actions will happen in the morning. Especially in the first 15 minutes to 1 hour is where majority of the actions kind of happen. That is the morning zone. Then comes the lunch zone or the mid zone or the zone 2, which is 11 a.m. to 1:30. 11 a.m. to 1:30. This is a period when the market is little dull and lull. No much of actions happen in the market, right? So market is predominantly sideways, and momentum is lost, and not much volatility as well. It simply kind of remains sideways. The exception to this is when there are certain results which are announced at around this time, say around 11 o'clock, 11:30, say for example some company announces a result, or there is a RBI policy, or some finance ministers make some announcement, or some trade announcements, or whatever announcement which happens during this time. That time we will see some amount of movement even at this time. Otherwise, generally zone 2 is a dull zone. Zone 3, which is the closing zone, is the most powerful zone, which means there is a huge momentum which picks up, and all the professional traders, they kind of jump on in the closing zone, and they kind of decide the eventual direction of the market. The whole day the market has been bearish, and in the third zone, if they also continue to be bearish, which means they have decided the market is going to go bearish. But in the third zone, if there is a reversal happening, that is when they decide the market is not bearish, it is bullish. And that zone is very, very powerful, both in terms of momentum and the participation which happens by the professional traders and the big fishes who kind of really trade. So ideal to trade is from the choice perspective, from the priority perspective, zone 3 is the best, followed by zone 1 and then zone 2. You can actually avoid zone 2. Zone 2 is actually a waste of time unless you have got a trade in zone 1 and you are carrying forward it and it is going good. So look for trades in zone 1 and zone 3, especially for the intraday trading thing. That's what are the 3 zones. Hope you kind of understood the 3 zones. If you kind of got all the 3 zones, type in the comment, got trading zones. Good. Now let us kind of understand the swing trade. Now we kind of went through that in the past. Again, I'm going to quickly go through, no rocket science here. Pretty much, right? Swing trade is typically happens, for a period of say 2 days, 3 days, even to a week, where you have to carry forward the position. Like I described earlier, it is like a swing. The price goes up and down and up and down. And when the price goes up and down, you kind of catch that swing. Now, how do you really catch that swing? Right, let's kind of describe that through a whiteboard. So typically, you would have seen the market is going up. This is how the market keeps going up, right? So now when the market goes up this way, here it went up to some extent, then it kind of came down. Again, this was the top, this was the low, this was the high, low, high, low, high, low. Now these are called as, all of these are called as swing highs and swing lows. Now what's our objective in swing trading is, from here to here, this is a swing. This part is a swing. Again, this is a swing. This is a swing. This is a swing. This is a swing, and this is a swing, right? So now our objective in swing trade is try to get in somewhere here and get out somewhere here. If it is long trade, and for a short trade, try to get in somewhere here and get out somewhere here for a very short duration, 2 days, 3 days, and consistently keep doing this. Every time I get an opportunity here. So if the market is kind of going up like this, right? What I do is I can short the market here, all these places. I can short the market, right? And all these places I can go long, right? And finding that area where you can go long and short in a shorter duration is the swing trade. This is between a swing high and a low, you capitalize these swings. So that is called as swing trade. Now I want to kind of tell you one more aspect here. If you are going to be doing swing trades, typically, this is, say for example, a bullish market. In bullish market, it is good that if you are doing swing trades, look at only going long, because overall the momentum is that the market is bullish, and within that the bigger view is that the market is bullish. Within that, if you do a long trade, from the swing low you catch up and do a long trade, your probability of the swing completing is very high, as against trying to do a short trade. It may, this is I've just kind of tried to draw it here. It may in reality, it may come down only this much but go up this much, come down only this much, go up this much. So it is better in that case that I avoid this short trade. I'm not interested so much, but rather do a long trade, because the move is going to be much better, because the higher time frames is bullish, so market may get pulled back up. So similarly on the short side, if the market is kind of going short like this, right? So you can avoid all these long trades here, avoid these long trades, and typically focus on shorting the market here, because overall the trend is bearish. right? So in a bearish trend, when you look at the chart at the longer time frame, you will get to know whether the trend is a bearish or a bullish. If it is a bearish trend, look for short trades in swing. If it is a bullish trend overall, look for long trade in swing. So this is called as the swing trade. Swing trade, what we kind of going to do. Hope you kind of understood swing. If you kind of are understanding swing, type in the comment swinging. Type in the comment swinging. Right. So just to summarize that, yes, typically hold the position for a couple of days to a week. You will hold it overnight or even over a weekend. Of course, we will use a lot of technical indicators. You've already learned a couple of technical indicators, and we will use them and see how to kind of do that. That is swing. And finally, positional trade. Pretty simple. Positional trades are those trades using a view for a very medium term to long term time period. It's like what is going to happen to the market in the next 5 weeks, 6 weeks, 7 weeks, 2 months, 3 months, 4 months. And accordingly, when you take a position, hold on to that for a sustainable period of time. So that is what is positional trade. We have already discussed this pretty much earlier. So you will ignore all the short-term price movement, intraday movement, swing movements. You will ignore that. You will simply hold on to that. So for doing a positional trade, one needs a very, very strong grit and a deeper understanding of the market situation, and more importantly, a strong belief in your system. Only when you have a strong belief, you will be able to do a positional trade, because you got to hold it. Because suddenly one day it will go up, suddenly 2 days, 3 days it will come down, then again it will take support and go up. But for you, when that is happening, when the market is against your position, if you have taken a long trade, your emotions will play a lot. So you got to kind of hold your emotions and accordingly play that with the longer term, medium term to longer term view. So that is called as the positional trade. Hope you kind of got a positional trade. If you have got all positional trade and all other 2 kinds of trade, type in got predictive. I'll come in the next video and we'll talk about few considerations for you to have in mind before you jump on to trading. See you in the next video.